Welcome to the latest edition of International Tax News. I'm Doug McHoney, PwC's International Tax Services Global Leader. In this edition, we cover selected tax updates from around the world, including my favorite topic, Pillar 2. If you would like to go in-depth on similar topics, check out the Cross-Border Tax Talks podcast, in video on YouTube or in audio wherever you find your podcast. Now turning to our current edition. First, EU member states agreed during their March 11th ECOFIN meeting on the Directive on Administrative Cooperation in Taxation, referred to as DAC-9. DAC-9 was introduced in October 2024 to facilitate the exchange of Pillar 2 top-up tax information between member states and allow MNEs to file one top-up tax information return at the SETRA level for the entire group. The proposal also transposes the OECD's July 2023 Globe Information Return into EU law. Member states, including those that have opted to defer implementation of Pillar 2, will have until December 31st, 2025 to transpose DAC-9 into national law. Next, there are 4 tax reform bills currently working their way through the legislative process in Nigeria. The process is at an advanced stage, and the bills could become effective this year. The primary bill on income taxation consolidates all existing income and gains tax acts into a consolidated bill. It introduces wide-ranging changes, including the introduction of a minimum effective tax rate for Nigerian companies. The bill provides for a minimum ETR of 15%, payable by Nigerian companies that are constituent entities of a multinational group or have aggregated annual turnover of $20 billion in local currency. A Nigerian parent company is also exposed to a top-up tax if its foreign subsidiaries tax is lower than the minimum ETR. Finally, President Trump has issued several executive orders aimed at digital service taxes and other measures perceived as unfair to U.S. businesses. These executive orders call for a review of countries' tax and trade practices and suggest possible actions such as withdrawing from a 1984 tax treaty with China and reviewing U.S. involvement in international organizations. The policies outlined in the EOs have significant implications for companies engaged in U.S. cross-border trade and investment. The administration's stated goals are to make the United States a more attractive place to invest, remove perceived advantages of other countries, and support key U.S. industries like technology. However, these measures may increase uncertainty and stability in the global economy and escalate intergovernmental conflicts. Thank you for reading PwC's International Tax News. I look forward to speaking with you again on the next edition and on the next episode of the Cross-Border Tax Talks podcast.